Okay, we'll do a new module 85. This is deductions from gross total income, section 80C, part 1. Part 1, I will give you the theoretical aspects. Part 2, I will do one problem, so it will be clear to you. Now, gross total income. What is the meaning of gross total income? We know that there are 5 heads of income: income from salary, house property, capital gain, business or profession, income from other sources. So the total income computed in accordance with the provisions of the Income Tax Act 1961 before making any deduction under chapter 6, that is section 80. Section 80 is giving with the deductions. The aggregated income from all heads of income, the 5 heads of income I mentioned, after applying the provisions of clubbing of income and set off of losses, is known as gross total income. Now, types of deductions under section 80. 2 types of deductions are there. One is deduction in certain respect of certain payments, that is section 80C to 80GGC. Second is deduction in respect of certain incomes. So one is payment, second is income. 2 types of deductions under section 80. So 80C is coming under payment, when you are paying something. Now, important points regarding deduction under section 80C. This deduction is allowed only if the taxpayer opts for the old tax regime. It is not allowed under new tax regime. Then no deduction is allowed under section 80 if the gross total income is either nil or negative. Third is timely filing of income tax returns is a must for claiming deductions under section 80. Then the claim for any deduction under section 80C is to be made by the assessee. Assessee has to claim. Income tax department will not take any initiative. Now, if a deduction is claimed in respect of any payment of income under any section of chapter 6A, that means section 80, then no deduction shall be allowed under any other section for the same payment of income. Income tax provisions are very clear. Only one income and one expense under one place only, or one head of income, or one claim only you can make. You cannot make double claim. Second is deduction is allowed with reference to the income included in the gross total income. Now, deduction is allowed up to rupees 1,50,000 in a financial year. Only individuals and HUFs can claim this deduction. Total deduction under section 80C, 80CCC and 80CCD together cannot exceed 1,50,000. Now, whatever the amount, qualifying amount, it is deducted from the gross total income to arrive at the total income. Now, I am going to give you the list of eligible deductions under section 80C. So, first one is payment made towards statutory provident fund, recognized provident fund and public provident fund. We have learned this under the head provident fund in detail. Statutory meaning it's compulsory, recognized meaning recognized by the Commissioner of Income Tax, public provident fund meaning it's started by self-employed people or business people. Conditions: amount to be paid by the assessee fully qualifies for deduction. Repayment of the loan taken will not qualify for this deduction. Second is amount deducted and deposited by the employer towards group insurance. Every organization will have a group insurance because anything happens to the employee during working hours, then the employer has to pay the compensation. So if there is a group insurance, insurance company will pay that. So group insurance will be there, fully qualifies for deduction. It will be a nominal amount, but all the employees, when they will contribute, it will become a considerable premium. Third, amount deducted from a government employee's salary towards a deferred annuity. That is, provision of the assessee, spouse or children, and amount not exceeding 20% of his or her salary. Next is details made in approved superannuation funds, retirement funds, fully qualifies for deduction. Next is deposits made in unit linked insurance plan or ULIP of UTI or LIC. Amount can be deposited in the name of assessee, spouse or children. It fully qualifies for deduction and lock-in period of 5 years for investments. If you are withdrawing before 5 years, it will be treated as income of that year and will be taxed. Next is amount invested in National Savings Certificates 8th and 9th issue. Fully qualifies for deduction. Interest accrued on these certificates purchased earlier is also eligible for deduction. Now, next is amount invested in National Savings Scheme NSS 1992. Fully qualifies for deduction. Next is amount paid to LIC under Jeevan Dhara 1, New Jeevan Akshay 1, New Akshay 2 policies. Amount invested in the name of the SSC fully qualifies for deduction. Next is amount invested in notified pension fund set up by mutual fund or UTI fully qualifies for deduction. Next is amount invested in National Housing Bank fully qualifies for deduction. Next, amount deposited with an authority engaged in housing development or town or rural development fully qualifies for deduction. Next item, any subscription in the deposit scheme of the central government fully qualifies for deduction. Next is deposit in Suganya Samriddhi account. This is in the name of a girl child. As a subscription in the name of a girl child of the individual, where the individual is the legal guardian of the girl child. Then term deposits with the banks for not less than 5 years duration as framed by the central government fully qualifies for deduction. Next is amount invested in equity linked savings scheme or ELSS. Actual amount invested is eligible for deduction. Amount invested in equity linked savings schemes notified for rebate under section 88 is also eligible for deduction. Next is repayment of the principal amount of the housing loan for the purchase or construction of the house property. Please remember, it's only the principal amount, not the interest. Interest will be adjusted in the computation of income from house property. Housing loan from government, LIC, bank, HDFC, HUDCO or other housing finance companies. Institutions or the institutions by or from the employer. Amount of loan taken from friends or relatives are not eligible. Now stamp duty and registration charge can be included for deduction. Next is not interested in housing loan or group rent. In ground rent, not possible to claim the ground rent or the housing loan. The ground rent cannot be claimed. Now a house acquired cannot be transferred before 5 years from the date of possession of the house property. Next is payment of tuition fees for 2 children. This is very important. Tuition fees paid to any school, college or university or other educational institutions situated in India. If the child is studying outside India, it's not possible. Next is full-time education of 2 children in India. Then development fees or donation paid at the time of admission is not allowed. Next is amount invested in equity shares or debentures in an eligible issue. Amount paid as subscription to equity shares or debentures of a public company or a public financial institution forming part of any eligible issue of capital. This issue of capital must be notified by the Central Board of Direct Taxes. Now such equity shares or debentures cannot be sold or transferred within 3 years from the date of acquisition of shares. Next is amount invested in units of mutual fund. Mutual fund schemes notified by Central Board of Direct Taxes. This exemption cannot be claimed for deduction under section 54EA of capital gains. Mutual fund units cannot be converted into money for 3 years. That is the lock-in period of 3 years. If such units are converted into money before the expiry of 3 years, the amount of rebate claimed earlier shall become tax payable in the year in which these units are sold or transferred. Now subscription to the bonds of National NABARD, National Bank for Agricultural and Rural Development, as notified by the central government, will qualify for deduction. Next is 5-year term deposit in an account under Post Office Time Deposit Rules 1981. This most of the people are using. So you have to remember lock-in period of 5 years. If the amount is withdrawn before the expiry of the 5 years, it is deemed to be the income of the year in which it is withdrawn and it will be taxed. Next is deposit in an account under the Senior Citizen Savings Schemes Rules 2004. This also most of the retired people are using to keep their retirement benefits. Lock-in period of 5 years. If the amount is withdrawn before the expiry of 5 years, it is deemed to be the income of the year in which it is withdrawn. Next is, it is not taxed if withdrawn by the legal heirs. When the legal heirs will withdraw, that means the taxpayer is died. Then if within the 5-year lock-in period, if the taxpayer died and then the legal heirs will withdraw, then it will not be taxable. Next is contribution by an employee of the central government to his or her national pension scheme. Amount contributed fully qualifies for deduction. Pension must have been made for at least 3 years. this pension scheme must be notified by the Central Board of Direct Taxes. Now regarding LIC premium, there is maximum limit of LIC policy. 3 heads it is there. Policies issued before 1/4/12. 1/4/12. Next is policies issued on or after 1/4/12. 1/4/12. Next is policies issued on or after 1/4/13. 1/4/13. 1/4/13 on the life of a person with disability. So here actual premium paid, actual or 20% of the sum assured, whichever is less. Whichever is less. Next is actual premium paid or 10% of the capital assured, whichever is less. So actual, here actual and 10%, whichever is less. Now in the case of disabled person, actual premium paid or 15% of the actual sum assured, whichever is less. See here it is actual and 15%. So these rates are important. LIC premium computation will be there under section 80C. So you have to remember the dates are important. Policies issued before 1/4/12, 20% is allowed. Policies issued after 1/4/12, only 10% of the sum assured is allowed or the actual value, whichever is less. If the policy is issued after 1/4/13 and if it's on the life of a person with a disability, actual value or 15% is allowed, whichever is less. So this is what I wanted to explain in this module. Happy learning. Thank you.